Hello, hello, hello. Welcome. For those of you who are watching me for the very first time, my name is James Ambroise, and on this channel, we cover how to pay off debt faster than any other debt repayment method out there. We cover basic bookkeeping and accounting for someone who just started out a small business. We cover basic personal income tax to include a Schedule C, Schedule E, depreciation. I am also the author and creator of Ambroise Method 1.0 and Ambroise Method 2.0. Ambroise Method is a revolutionary debt repayment method that offers greater results in terms of reducing interest cost compared to debt snowball, debt avalanche, velocity banking. Real quick about my credentials. I have been or am a bookkeeper and accountant, QuickBooks Pro advisor, senior tax advisor, residential real estate investor, residential property manager, financial coach. And as always, before we get started with what's on the board, please allow me to shout out the name Jesus, my Lord, my God, my Creator. Thank you. All right, America, on the board we have this hypothetical scenario of somebody who filled out one of my Microsoft Excel worksheets. And the person provided me with these figures. For that, this person has a secured personal loan, credit card, HELOC, and a fixed rate mortgage. Okay. The original loan amount, the credit limit, $32,000. APR, 30%. Balance owed, $20,000. Monthly payments charged, $1,035.31. And this secure personal loan is a 5-year personal loan. Okay. On the credit card, this credit card, the expense, $4,000 is the total expense, but $1,900 could go on a credit card. Okay. For the HELOC, it's an interest-only HELOC, so they only charging interest. It's a 10-20 HELOC, so 10-year draw, 20 years repayment, and we are still in the draw period. And the previous day balance was $10,000. Now, I don't have any amount for the monthly payments charge. That's why I put a question mark, because we're going to figure out, okay, for the cycle, what the monthly payments charge will be. Okay. All right. And on the fixed rate mortgage, it is a 30-year fix. The APR was only 2.65% back in 2021. So back in year 2021, the APR was that low, 2.65%. Okay. Now, America, from past lesson, we talked about our debt repayment equation. And our debt repayment equation is income equals expenses plus cash flow. Okay? We're doing a scenario for a financial coach from Velocity Banking. Okay. The figure that was provided, income $6,000, expense $4,000, which means that we have a cash flow of $2,000, because cash flow is the relationship between the income and the expense. That relationship calls for a subtraction operation, so $6,000 minus $4,000, that's how we arrive at $2,000 cash flow. And again, out of these expenses, $1,900 could go on a credit card. $1,900, $1,900. Okay? Out of the $4,000 expense. All right, America? Again, we're doing a scenario for a financial coach from Velocity Banking. Okay? That's our hypothetical scenario. All right, America, I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to start with the exercise. All right, America. Today we're doing case study number 16. And today's date is May 31, 2025. Okay? That is the day that I'm doing the video. All right? America, there are still a few lessons that I haven't covered yet. Paycheck allocation. That's one lesson I have not covered. Debt consolidation or refinance. That's another lesson. Consolidation of due date. That I told you guys from past lessons. And 3 alternative accounts simultaneously. Okay. And again, paycheck allocation, debt consolidation or refinance, consolidation of due date, and 3 alternative accounts simultaneously. And again, the reason why I haven't covered these lessons, or at least some of them, because some of them are kind of complex, okay? So I want to make sure you guys get the foundation first with Ambroise Method before I start introducing more complex type item, especially this consolidation of due date, and definitely 3 alternative accounts simultaneously, okay? All right, America, today I'm a little upset because of my competitor over at Velocity Banking Group. Some of these folks start copying what we are doing. So they start to emulate what we are doing over at Ambroise Method. Okay. And that's not cool because they are our competitor. Now whatever edge that we have over these guys, now if they start copying what we are doing over at Ambroise Method, now, you know, that becomes a problem. Okay. So this lesson is to kind of put those guys on notice, to tell them to please stop copying or stop trying to emulate what we're doing over at Ambroise Method. Okay. Now, in the past, these folks used to tell their client, their followers, hey, on the credit limit, especially on the HELOC, you can only go 2/3 of the credit limit. Okay? And then later on, they decided, hey, you could go up to 80% on the credit limit. So whatever the limit is, in this example, 10,500, let me grab my calculator. So if it's 10,500, you could only go 2/3, so that would have been 7 grand. Okay? 10,500 times 2 divided by 3. Or 80%. For 80%, 10,500 times 80%. So you couldn't go any higher than 8,400. Okay. So if you're trying to make a chunk payment, whatever balance that you already have on the account, plus the chunk payment, altogether it could not be no more than 7,000, or it could not be no more than 8,400. Okay, including whatever balance that you already have on that account. Okay. Now these guys, because they start copying what we are doing, because for us, we don't go 2/3 or 80%. Okay, we go close to 100%. Okay? So now, a couple months ago, I've watched these guys now start telling their client that, hey, you could go a little higher than 80% on the credit limit. So now you have some of them that might go as high as 95%. I've seen an example where one went as high as 95%. So in this example, 10,500 times 95%, in the case of an HELOC, so he'll be 9,975 bucks, so close to 10 grand. Okay? So now they could be close to 10 grand. 9,975 or 10,000. Okay? That's a big jump, America. From 2/3, which is what? 66, 67% to 80%. Okay? Now they could, some of them start going as high as 95%. Okay? So from 66, now they're going as high as 95. That's a big jump. Let me see how much that is. 95 minus 66. That's about 29% additional. Okay? 66 minus 99. 95. I mean 95 minus 66. Okay? That's a big jump. If it's 80, 95 minus 80, so we are at 15. An additional 15% on the credit limit. That is a big jump. Why they want to go higher now? Because, again, they start copying what we're doing. So they realize that this guy gonna have a big edge on us because he is our competitor, because he's going a lot higher on the credit limit. Okay. And part of the reason why some of them, not all, some of them in the past used to stay 2/3 of 80%, because these folks, some of them didn't fully understand how credit score work. They think for going higher on the credit score, on the credit limit, that's going to affect the credit score. And we know a lot of times people are increasing the balance on the HELOC. A lot of times they are increasing the balance so they could decrease the balance on the credit card. So if you are increasing, America, the balance on the HELOC, so you could decrease balance on credit cards, okay? It is a good exchange, so go ahead and do it. It's not going to affect the credit score, okay? Because the credit card is unsecured and the HELOC is secured by our home. The way the credit score is calculated, it is more advantageous, more beneficial to increase the balance on the HELOC so you could decrease the balance on credit cards. Because a lot of folks, they have a bunch of credit cards, okay? So 2/3 of 80%, now they want to go as high as 95%, okay? And again, they're trying to emulate what we are doing over at Ambroise Method, okay? Because they finally come to their senses, realizing, oh, this guy was right. Increasing the balance on a HELOC to decrease the balance on credit cards is a good exchange, okay? So go ahead and do it, okay? So now that's why now they want to go, some of them I've seen going 95%. So they abandon this 2/3 or 80%, completely abandon it now. Now they want to go higher on the credit limit, especially in the case of a HELOC. Okay. America, over at Ambroise Method, we lead, we do not follow. Okay. Why? Because we master this thing called paying off debt. So, if you were to ask these guys, well, how come you guys make such a big jump from 2/3 or 80% all the way to 95 now? Some of them, they'll tell you the preferred word is that, oh, we are evolving. These folks in America, every couple of years, they are changing something over at Velocity Banking. Every couple of years. And we're going to get to that a little later in the lesson. So that was the first time I've noticed that they are copying what we are doing over at Ambroise Method. So that was the first time I noticed that. A couple of weeks ago, I'm watching another one because, you know, I have to continuously do my research on those guys because they keep changing things. Okay? I noticed this financial coach teaching about velocity banking. Now she's telling her client or followers that, hey, you guys have to change the due date. You guys have to change the due date. So again, they're trying to copy or emulate what we are doing over at Ambroise Method. Okay. From day one, we've been talking about changing the due date. These folks over at Velocity Banking Group, for all the years that they've been into existence, multiple years, not once have they told their client to change the due date. Now all of a sudden now, because they are watching what we're doing over at Ambroise Method, I've seen this. It was a lady, a financial coach, teaching about velocity banking. Now she started telling her clients to change the due date. This 95%, that example was from a guy teaching about velocity banking. This due date, this one was from a lady teaching about velocity banking. Okay. Why? All of a sudden now they want to change the due date because, again, from watching some of our videos, you know, these folks, they didn't fully understand how this average daily balance work. You remember, for average daily balance method, the way some lenders, not all lenders, the way some lenders arrive, well, the way most lenders arrive at the monthly interest cost for the cycle, they use an average daily balance, including new transaction with compounding. Okay? And we're going to go over that on the board because on the board I have the average daily balance calculator on the board, and we're going to go over that a little later so you guys have a better understanding why now these people are talking about changing the due date. And again, they've been watching our videos. Okay, you know what, this guy makes sense, so now they start telling their client to change the due date. Okay, and I'm pretty sure they probably copy more items. Maybe I haven't watched those other videos yet, but so far this is 2. Okay, they've copied 2 ideas, you know, from what we are doing over at Ambroise Method. They're going higher now on the credit limit when they're getting ready to chunk or to send a transfer. And now with regards to the due date, you know, for the expenses, if the expenses due on the, say on the 5th, they're trying to change the due date now towards the end of the month. If the expense is due on the 12th, you don't want it to be due on the 12th. You have to call the bank, call the creditors, and try to change the due date to be towards the end of the month. Okay, which is why we've been preaching since day one, since we started introducing Ambroise Method. So, and again, for the folks over at Velocity Banking Group, I'm putting you guys on notice, okay? Stop copying what we are doing over at Ambroise Method, okay? Because whatever edge that we have over you guys, okay, we want to keep that edge, all right? Because maybe I might be forced to do something. I don't know yet. So, their favorite word again, if you ask them, well, how come now you guys want to change the due date? All those years you never told your client to change the due date. Their favorite word again, oh, we are evolving. Okay. Every couple of years, these folks over at Velocity Banking, sometimes every few months, they are changing something. So, a little history, America, about Velocity Banking, at least the way that I remember it, the way that I remembered it. These folks, when they first started out, they were using a credit card as their debt weapon or as their debt tool to pay off debt. So when they first started, they were using a credit card. And then after a little while, a few months later, or a few years later, they realized that a credit card is kind of limited. Okay, because part of the problem with a credit card is that not every bills, not every expenses can be paid with a credit card. It's not really a problem, but the way that they use their so-called debt weapon, so it's a problem for them. So they move from the credit card, they start telling their clients, hey, you have to go get a PLOC to pay off debt. Okay, personal line of credit. And on the business side, you could go get a BLOC. Even on the business side, you could kind of, be smart about it to where you still, in a way, pay your personal debt, through a BLOC. Okay. And I might get into that at a later time. Well, not at a later time, on a different lessons. Okay. To show you guys, even though on the business side, you have an issue on the personal side to where you could use some item from the business side to help you facilitate your fight against debt on the personal side. Okay. Again, that's kind of more complex type item. Maybe I need to add that to the list of lessons that I want to do. Okay. Now, a few months went by, they've noticed that the PLOC or BLOC is kind of limited. For one, the terms on the PLOC, a lot of times a lot shorter, like 3 years, 5 years, okay? The most common ones, okay? So they've noticed that the PLOC could be a problem. And sometimes the PLOC also have some other restrictions. So the PLOC couldn't really get the job done for them because of the way they use these accounts, okay? So a few months later, a few years later, they start telling their client to go get an HELOC. And this thing did not get rolled out all at once. It's like every few months later or every couple of years later, they start introducing these other items, okay? It wasn't all at once. They start talking about it. And again, these folks, they are evolving. Every couple of months or every couple of years, they're changing something, okay? And they forgot that for HELOC, you have to have a house. And not every person living in America has a house, has a home, because we have some renters in America. Okay? Well, that created a little problem. And one of them was thinking outside the box. They start telling the client, hey, you know, you need to go out there trying to acquire a life insurance policy in order to facilitate your fight against death. So a few months later or a few years later, they were asking folks to go get a life insurance policy. And again, to help facilitate your fight against death. Can you imagine? In order for me to pay these little debts that I have, I need to go ahead and get a life insurance policy. These salesmen over at Velocity Banking, they were terrible, man. Because most people, they are ignorant when it comes to this personal finance, but they are not stupid. So you meant to tell me that I need to go get a life insurance policy in order to pay off debt? So, and again, they keep evolving. Now there comes a new product out there called all-in-one loan. Or first lien HELOC. Sometimes these two terminologies are interchangeable, but they could be different product, okay? They could be the same product or different product or slight variations, okay? So when this all-in-one loan or first lien HELOC, you know, was introduced, the very first one was a first lien HELOC with a one-way sweep. One-way sweep. Again, with this new product, these folks over at Velocity Banking Group, they were not doing their due diligence. They started to tell their client to go get a first lien HELOC, all-in-one loan or first lien HELOC with a one-way sweep. And again, because they're not doing their due diligence, they did not know that a one-way sweep won't be able to get the job done. Because a lot of times, you know, the way that one-way sweep works, because I don't want to spend too much time on it, because I've already covered this item extensively from our past lessons, okay? Folks were forgetting to move the money back, okay, to the checking account in order to pay off debt, to pay off the debts, okay? So this one-way sweep was a problem. Again, it's a new product. These coaches teaching about Velocity Banking, they were telling the client to go get a first lien HELOC with a one-way sweep. Again, not thinking things through, okay? Not trying to properly analyze this thing before they tell the client to go get it. Later on, they realize this one-way sweep's not getting the job done. So now somebody was thinking outside the box. This time, they introduced not a one-way sweep, but they introduced a two-way sweep. Now, this two-way sweep cures some of the deficiency that the one-way sweep has. That's why he has a two-way, not a one-way. And again, I'm not going to spend too much time on it. I've already covered two-way sweep from our past lesson, our past case studies, okay? So, as you could see, they've jumped from a credit card. Initially, the folks of our Velocity Banking, for the debt tool, they were using a credit card. A few months later, it was a PLOC or BLOC. A few months later, it was a HELOC. A couple of years later, they were telling people to go get a life insurance policy to help facilitate their fights against debt. Then a few years later, all-in-one loan product come onto the market. They're telling their client to go get an all-in-one loan. Again, they keep chasing any shiny object that comes into the market. Every new product. First in HELOC, one-way sweep. A few years later, then a few years later again, two-way sweep. Okay? All these products are kind of limited. So now they kind of fall back onto the HELOC. The HELOC seems to be now their favorite debt weapon. Again, because remember they had HELOC in the past already. Now they're back to HELOC again. Okay. Now, it is true, all these could be options, but they didn't introduce all these options all at once. It was a few months later, okay? After they've been doing Velocity Banking for some time, a few years later, after they've been doing Velocity Banking for some time, a few more years later, okay? And again, these folks, they keep evolving. You are not evolving. You need to stop and think, okay? Before you start telling your client to go use something, okay? You have to analyze this product first. That way you don't become a laughing stock to where every couple of years you're forced to change something. Because again, you did not introduce those things all at once, over a short period of time. All these items in America were over several years. Okay. So I'm on the sideline, I'm watching this going on. So I'm telling myself, you know what? When I'm getting ready to introduce Ambroise Method to the world, okay? Of course, we make sure that we do our due diligence. Okay? We make sure that we stay consistent. We make sure that we have a cohesive message, unlike these folks over at Velocity Banking Group. Okay? You cannot keep evolving every couple of years. Over multiple years, you're changing something. Okay? Which means truly you had an inferior debt repayment method. That's why you are forced to adjust every couple of years. So how many adjustments you're going to make? Now, in addition to that, now they start copying what we are doing. 2/3 to 80% at first of the credit line of credit limit. Now they want to go as high as 95%. There goes another change. Years later. Why? Now they start watching our videos. And again, maybe they have stolen more items from me. I just haven't watched those videos yet because I don't have time to be, doing research on those guys, because I thought I was done doing my research on them. But every couple of years with this group, they're going to introduce something new. So now I'm forced to keep watching this. So 2/3, 80%. Now they want to go 95%. Okay. Emulate. They're trying to emulate what we're doing. Now they're telling about the folks to change the due date. They're trying to again emulate what we're doing. Okay. America, 95% still low. Okay. Depends on the example. You know, we like to be in the 90s, especially in the case of a HELOC. Okay. When we're using the HELOC, when we're increasing the balance in the HELOC to pay down credit cards, we go close to 100% really. I've done an example in the past where I think it was either 98% or 99%. We go close to 100% really. Okay. But you got to be careful though, because the closest that you are to the credit limit, okay, you have to make sure though that, you know, when you add the following payment that is due, that you do not go over the limit. So you have to be careful when you find yourself in the 90s. Okay. After a transfer. All right, folks, look at all these changes over multiple years. Look at all these changes for velocity banking. These things, they did not get rolled out over a few months. Those things over multiple years, more than 5 years, more than, you know, I don't remember how long this guy's been into existence. I don't even know, to be honest with you. But for sure, more than 5 years. Okay, look at all the changes. That's why these folks are becoming laughing stock. Cannot keep changing things every couple of years. Life insurance, all in one loan, first in HELOC, one-way sweep, first in HELOC, couple years later, two-way sweep. Because there was a lag between the one-way and the two-way. Okay. I need to go back to find out when this old one-way came into existence and when the two-way was introduced. Okay. So, keep changing things. Not good. Not only that, you have some of the financial coach teaching about this thing over at Velocity, teaching about Velocity Banking Group. They can't even make up their mind what they want to call it. Some of them, they started out, oh, it's a debt weapon. So later on, you find coach number two wants to call it, oh, let's call it a debt tool. Then you find another coach number 3, want to call it a line. Then you find another coach, you know, these YouTubers. America, I am not a YouTuber, at least not yet, okay? Because I don't consider myself a YouTuber if I'm putting a video once every month. I'm putting out a video once every 3 months. I'm putting out a video once every 6 months. I don't think that qualifies me as a YouTuber. Okay? But those guys, there's like thousands of them, it seems. They flooded the market. You cannot go on YouTube and not find somebody teaching about this nonsense. And we're going to prove that a little later when we start getting into the lesson. Okay? So, going back to the coaches, one of them want to call it a debt weapon, another one want to call it a debt tool. You find another coach that want to call it a line. Then you find coach number 4 that want to call it a credit line. Then you find another coach. This coach, hey, I don't like those names. Let's call it a debt destroyer. Then you find another coach. This coach doesn't want to call it a debt destroyer. He want to call it Conan the Destroyer. And you find another coach, he doesn't want to call it Conan the Destroyer. He wants to call it Conan the Barbarian. Now I'm just making fun. These other two, I'm just joking around. Conan the Destroyer, Conan the Barbarian. I'm just joking around. But yeah, but you have this coach, debt weapon, let's call it a debt weapon. Another coach, let's call it a debt tool. Another coach, let's call it a line. Another coach, let's call it a credit line. Another coach, you find another coach teaching about velocity banking, let's call it a debt destroyer. All these coaches, they're all teaching about velocity banking group, but they don't even have a consensus what to call the so-called debt weapon or debt tool. They can't even agree on what to call the thing. And they're all teaching about velocity banking. They don't even have a consensus on that. So no cohesive message at all. With regards to the name, they don't even know what to call it. They cannot agree on what to call it. So no cohesive message on the name itself, and no cohesive message as to how they go about their business, because we have some factions that wants to attack a mortgage, like the one that we have on the board, that would want to attack the mortgage first. So different factions. One of them want to attack the mortgage first, and another one who want to attack items other than the mortgage. Let's just put other. So if you give them an example like that, all of them are teaching about velocity banking. You got some, well, which account should I attack? There goes my example. You got some, because they have so many factions inside velocity banking. You got some that only wants to attack this fixed rate mortgage, 50 grand. Why so low? Why 50 grand? Because we have a few lenders that still allow you, the base minimum is 50 grand. You got some other lenders, the base minimum is much higher than 50 grand. Okay? So it depends on the lenders. On the lender. Okay? So yes, these folks teaching about velocity banking, one of them will want to attack the mortgage first. You have other group that wants to attack items other than the mortgage, so something else, like maybe the secured personal loan. So again, no cohesive message. On the name, they can seem to make up their mind what name to call the so-called debt weapon or debt tool. Because one will call it a debt weapon, one will call it a debt tool, another one will call it a line, another one will call it a credit line, and then you'll find another coach that'll call it a debt destroyer. No cohesive message at all. And with regards to how they go about their business, same problem. They don't even know which account to attack. And again, America, these folks over at Velocity Banking Group, they are becoming laughingstock. All right, America, I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America. America, on the board, I have an average daily balance calculator. Why an average daily balance calculator? It's because, again, we're trying to figure out what the monthly payment charge should be for the cycle. We're at the end of the cycle. Now, different lenders, America. Let's go over it first. For cycle, we have day 1, day number 1, day number 2, day number 3, 4, 5, 6, 7, 8, 9, all the way to day 30. Day number 30. Why I stop at 30? Because our competitor like to always use 30 days. Remember, this hypothetical question is from a financial coach that teaches about velocity banking. So these folks, they like to use 30 days on all their example. So we stop at 30 days. Okay? And remember, America, for the cycle, it doesn't always have to be 30 days. We have some cycle that have 28 days. Most cycles have 28 days. The cycles have 28 days, 29 days, 30 days, 31 days. Okay? So, again, it doesn't always have to be 30 days. Okay? Our competitor, Velocity Banking Group, these guys, they are misinformed a lot of times. Okay? So, and when I say day 1 of the cycle, day 2, I'm not talking about, for example, since we are in May, I'm not talking about May 1, May 2, May 3, no. Okay? Day 1 of the cycle, Sometimes it might coincide with the same calendar day, okay? Say for example, May 1 or January 1 or whatever. January 1 could be the same as day 1. Sometimes they fall exactly the same, they have the same path, okay? But we're not talking about the calendar day, okay? Day 1 could be, say for example, in January 18th or something, okay? Or January 25 or something, okay? Could be day 1, okay? So day 1 doesn't have to be the same date as the actual calendar day. Day 1 doesn't have to be January 1 for day 1, okay? Because I want to make sure you guys fully understand the distinction. But in some example, it might happen to be on the same day as the actual calendar day, but usually it's not. Okay. So, but we're talking about day 1 of the cycle. Okay. not the calendar date. Okay. So day one of the cycle, since for those guys again, most of the cycle has 30 days only. Always have 30 days. Okay. So the beginning balance, and again we're doing this scenario on the HELOC to find out what the monthly payment charge should be. Okay. The beginning balance, on our note, we say that the HELOC was interest only. It's a 10-20 HELOC and we're still in the draw period, so 10-year draw, 20 years repayment. And the previous day balance was 10,000. So if the previous day balance was 10,000, okay, that's the previous day. So before day one, it was 10,000, okay? So now 10,000 get rolled over to day one, so that's why it's 10,000, okay? So that is the previous day balance, okay? All right, so we have purchases or new advances, okay? Because remember, again, most of the lenders, most of the creditors, they use an average daily balance, including new transactions with compounding. So these purchases or advances, these are the new transactions. The payment or credits, these are the new transactions. So it's average daily balance, including new transactions. So I have columns for the new transactions, whether it's a purchase or whether it's a payment. Okay? And there goes the ending balance. So there goes the beginning balance, and there goes the ending balance. And we're going to start plugging some numbers in. Okay? So you guys can understand what we have on the board. Okay? And over here, same thing. On the cycle, day 1, day 2, day 3, day 4, because we're going to run a different scenario over here. Okay? Day 30, beginning balance, purchases, new advances, payment and credit, purchases, new advances, payments and credit, ending balance, So same exact items, okay? Because we're going to run 2 separate scenarios, all right? Because part of the reason why these folks over at Velocity Banking Group are harassing me on YouTube, okay? They keep sending me messages on YouTube. It's because I guess when I mentioned that dumping all of your income or dumping all of your paycheck onto an HELOC, a lot of times, 99% of the time, or I say a lot of time, it is the wrong thing to do. Okay? So I've been receiving a lot of comments from those guys over at Velocity Banking Group, especially on YouTube. Okay? So we're gonna try to help them out a little bit. Okay? To show them why it is the wrong thing to do, dumping all of your income or all of your paycheck onto an HELOC. Okay? So, earlier, America, I mentioned that most lenders, most creditors uses an average daily balance, including new transaction with compounding. But on the board, I have without compounding. I don't have what they use most. I have the one that they don't use as much without compounding. Later on, I'm going to give you the results for with compounding. Okay. And for those of you who are kind of wanted to get that knowledge, the reason why, you know, I'm a little paranoid about putting the formula that includes with compounding is because I just got burnt, man. Okay, the folks over at Velocity Banking start stealing my stuff, or start copying my stuff, I should say. Okay, so I don't want them to copy my formula on with compounding, so that's why I'm putting without compounding on the board. Okay, but don't worry, America, I'm going to give you the results of what you would have been with compounding, because that's what most lenders are using. Okay, with compounding, not without compounding, not the ones that is without compounding. Okay, all right. So in And the results are about the same, the one with compounding and with compounding. I'm talking about the overall result, the net result. Not the actual, the general result, but the net results are about the same. Okay? For what we're trying to achieve today. All right? Now, going back to the income was 6,000. The expense, 4,000, which give us a cash flow of 2,000. Okay? Remember, a lot of the folks over at Velocity Banking, they like to tell their client or their followers to go and acquire a new HELOC. So this HELOC was not on the board before. This HELOC is a brand new acquired HELOC. So this HELOC is only a few months old. Okay? So at some point, I guess the client say, okay, fine, you want me to go get a HELOC. So the clients already have a fixed rate mortgage. So the client went ahead, acquired a HELOC. That was a few months ago. Okay? Just like these folks want. And they've already executed a chunk. Okay? A couple months ago. So now this is our starting point. $10,000. That's a few months later now. Okay? Today is like a few months later. So let's assume that's our starting point. 10,000 bucks. Okay? Yeah. And since we're on the subject, again, folks, for paying off debt, okay, you don't always need to go out there and acquire a new trade line like a HELOC to pay off debt. You don't always need to go out there and acquire a new trade line like a PLOC to pay off debt. Okay? The reason why the folks over at Velocity Banking Group are telling their client to go apply for HELOC, to go apply for PLOC, is because of the way that they know how to use this so-called debt weapon. Remember, they only know how to use the debt weapon one way. And the only way they know how to use the debt weapon is to dump all of the income onto the debt weapon. So, to them, they think it's the greatest thing. They're going to dump all the income into the debt weapon. They're going to use the debt weapon as now their new checking account. That's what they like to say. Okay? It's still not a new checking account because at some point you have to move the money back into your regular checking account. But anyways, you know, these folks, they are misinformed. So, you know, America, you do not need to go out there and acquire a new debt weapon or a new trade line to pay off debt a lot of times. Now, in some applications, it is advisable to go out there and get a HELOC. It is advisable in some applications to go out there and get a PLOC. Okay? But in a lot of examples, or in some examples, no, you don't need to go out there and get a new trade line to pay off debt. Okay? Not at all, America. Okay. But sometimes you may have to. Okay. Only sometimes. Okay. Why? Because you could accomplish the same thing with a credit card. With a credit card, just like a HELOC, income could come in, expenses could go up. Not only that, on the credit cards, they are offering promotional rate or teaser rate. Anywhere between 0% to 1.99. For how long? Sometimes 12 months, 18 months, or even longer. Okay. On the HELOC, once in a blue moon, you might find an HELOC. As of today, we're in what? May 31, 2025. As of today, most of the HELOC, you might find a promotional rate or teaser rate, okay? Once in a blue moon, a lender might offer a teaser rate on an HELOC. But for sure, on a credit card, okay, these things are very prevalent. All the time you could find this type of promotional rate on new HELOCs. So which one would be better then? A 0 to 1.99 versus, like we have in this example, 9%. This 9% is constant. This one, 12 months later, 18 months later, within 12 months, you could still take advantage of it. Up to 12 months, up to 18 months, sometimes longer. Okay? So this idea to go out there and acquire a new HELOC or a new PLOC, when I could get a credit card that'll do just as good of a job, not just as good as a job, even better of a job than an HELOC. And some application. And some examples. Okay? So that is why I told you guys a lot of times it's not even advisable to go ahead and get an HELOC. That was on a credit card. Same thing with a personal loan. Even a personal loan, in some example, could be better than an HELOC. The reason why I start smiling, because, and we're going to get into that a little later in the lesson, because I heard a financial coach from Velocity Banking talking about that a line or credit line is always better than a loan. So line versus, later on we're going to do line versus loan. A line is better than a loan. So in other words, if you have the options to go out there and get a line or a credit line, like a HELOC or a PLOC, and you have the options to go get a loan, you should go for the line instead of the loan, according to them. And why? Again, these folks, they are misinformed. For one, a lot of them don't understand how interest rate works, and a lot of them don't fully understand the amortization schedule. Okay? So that's why they are confused. They think a line is always better than a loan, because in a line, you could have, let me use their terminology, you could have income comes in, expenses goes out on the line. On a loan, the word, you cannot have income, we could have income come in, but you cannot have expenses goes out. So this one is a two-way, this one is a one-way. So for that reason, again, they're not doing their due diligence, they're not thinking things through. Okay, these folks, man. Anyways, because I don't want to get too nasty today. A line is better than a loan. In what context, dude? We're going to get to that a little later in the lesson. So now going back to a personal loan. The personal loan, just like a credit card, you have some lenders that might also offer a promotional rate on a personal loan or a teaser rate. Let's put teaser rate here. Because a lot of time they want to earn your business. They want you to bring all your balances. You know, it's a debt consolidation, you know, sort of. They want you to bring all your balances from your other account into the personal loan. So they want to earn your business, so they are offering a teaser rate. Well, going back to the line versus the loan, like in this example, say for example, your line is 9%, 12%, 18%, because we got another line here, 18%, the credit card. Okay. So if you could get a credit line, a so-called debt weapon for them at 9%, 12%, 18%, versus a lender who is offering you a promotional rate or a teaser rate on a personal loan, okay? So you could get one of these items or you could get that one. So which one should you pick? But this one, say they have a teaser rate of what? 1%. I don't know if they still offer a teaser rate of 1 anymore, but let's say they have a teaser rate at similar to this one, 2.65, just for you to bring your business over. %. So I could get a line at 18. Meanwhile, I could get a loan with a teaser rate for ever how long, okay? Some of them could go as long as, even some of them could go even longer than what the promotional rate will be on a credit card. A credit card, 6, 12, 6, 9, 12, 18 or longer. Those guys, if they want to, they could go up to 5 years. Well, not up to 5 years. They could go about 5 years, or they could go about 3 years on the teaser rate. That's on a personal loan, America. So if I could get a teaser rate for that long, even for 1 year, even for 12 months, let's say 1 year, 2 years, 5 years. Okay? Versus I could go out there and get one at 18%. Between 9 to 18%. Okay? Well, let's say we're dealing with the 18% one. Okay? And again, why? Because they're not thinking things through. They're talking a line is always better than a loan. I'm talking about the folks of our Velocity Banking Group. But in what context? So you meant to tell me if I could get a line at 18, meanwhile, a different lender could offer me a debt consolidation with a teaser rate of 3% to bring over, so I could bring over all the business to them. So you meant to tell me a line versus a loan, I need to go pick the 18% loan? Doesn't even have to be 18%, okay? Depends on the example. Even a 9% will be wrong. Depends on the example. Okay? So again, these folks, they're just talking, man. Folks of our Velocity Banking. If you have the options to get a line versus a loan, go ahead and get a line. Okay? They're not thinking about all the different scenarios. I don't even think they are aware that on a personal loan that a lender could offer a teaser rate just like a credit card. Okay. Because these folks, their background when it comes to personal finance is kind of questionable. Okay. And they are the ones teaching you about how to pay off your debt. They're trying to educate you about personal finance. Most of these guys, I'll say 99% of them, because I watched quite a few videos when I was doing my research, and now I found out that I still need to do more research, because again, they keep evolving. They keep changing something every few months or every few years. I'll say 99% of these folks, they have no clue what they are talking about. They are confused, man, about this thing. You know, they like to say things, say catchy phrases. Line is better than a loan. Line is better than a loan. Again, folks, they are becoming laughing stock. I'm talking about the folks of our Velocity Banking Group. A line is better than a loan. I could consolidate at a teaser rate 3% for 1 year or 2 years or 3 years or sometimes all the way up to 5 years. Meanwhile, your line is 18% or your line is 9%, depends on the example. You're telling me a line is better than a loan? No matter how much income or how much of your paycheck you dump onto the line, you'll never be able to catch up with the loan. And we're going to go over all of that in the lesson. Okay? America, over at Ambroise Method, we are the shepherd, shepherding the flock. When it comes to this paying off debt thing, we are specialists over at Ambroise Method. Okay. We didn't just wake up and start teaching about personal finance. Listen to the background. Listen to some of the credentials. Only some. Bookkeeper and accountant. Bookkeeper and accountant. Uh-oh. Working with numbers. QuickBooks Pro Advisor. Uh-oh. We are working with numbers. Senior Tax Advisor. Uh-oh. We are working with some more numbers. Residential real estate investor. Working with numbers still. Residential property manager. Working with numbers. Financial coach. So, a long tenure, long time dealing with numbers. We don't just wake up one day and start coming up with debt repayment method. And these folks, they're calling themselves financial gurus. I'm talking about all of them. You cannot call yourself financial gurus, or people are calling them financial gurus, when your debt repayment method is debt snowball. Now, can't even properly pay off debt. Someone cannot call your financial gurus when your debt repayment method is debt avalanche. And I'm going to cover all of that at the end of the lesson. You cannot call yourself a financial gurus, or someone cannot call your financial gurus when your debt repayment method is velocity banking. Okay. These folks, they never do their due diligence. They just saying stuff. A line is better than a loan. Okay. Amortization schedule, a loan, a mortgage has the word mort in it or mors in it. That's the Latin word that means death. And again, they're trying to demonize the mortgage. Why? Because they don't fully understand this amortization schedule or how interest rate works. America, if a financial guru is an 8, a 9, or a 10, these folks, I wouldn't even score them a 4. I'm talking about all of them. The ones that are yapping on radio, yapping on social media, yapping on TV. All of them. The reason why I get a little upset about this thing, because these folks, okay, teaching about this nonsense, the folks of our Debt Snowball group teaching about this nonsense, the folks of our Debt Avalanche group teaching about this nonsense, the folks of our Velocity Banking group teaching about this nonsense. And again, the reason why a lot of times I get a little upset, because we have people with real problem, man. Based on a study that was conducted by the Federal Reserve, where they found out that 64% of us are living paycheck to paycheck. And 68% of us cannot come up with $400 emergency. So these people over here, they're relying, they want to go on social media and hope to get help with this personal finance. And again, they are living paycheck to paycheck. Meanwhile, you got these guys with regards to that snowball talking about, oh, the way that you pay off debt is to attack the lowest balance. For that avalanche, the way to pay off debt is to attack the higher APR. And for Velocity Banking Group, well, you know, anyways, don't get me started with those guys. They are a confused bunch. They don't even have a cohesive message on what to call this thing as far as the name itself, the debt weapon. Some of them want to call it debt weapon, line, credit line, debt destroyer. No cohesive message. And you have this group teaching about velocity banking. They can't even have a consensus on how to go about their business. You have some that want to attack a mortgage. You have others that want to attack items other than a mortgage. So you as the regular Joe or regular Jane, you're trying to get some help from these people, and they're spewing out this nonsense, whether it's on YouTube, whether it's on the radio, whether it's on TV, whether it's on social media, other platforms. That is why sometimes in America I get a little upset, because I know this money thing gonna bring a lot of stress. Okay? When you're waiting for the next paycheck. And you could have gotten some remedy if you're following the right plan, but because these folks, they're flooded, they're all over social media. They are on TV, they are on radio, they are everywhere. Okay? And you're trying to get some help. But these groups, their plans got too many flaws, man. Too many flaws. And again, we're going to go over that a little later in the lesson. All right, America. I'll give you about 5-10 seconds to take a look at what's on the board. And then we're going to continue with the exercise. All right, America. All right, America. Finally, we're going to get to the lesson. And again, on the board, I have the average daily balance, including new transactions without compounding. Okay? But most lenders uses, some lenders uses a previous balance method. Other lenders use a adjusted balance method. So you have previous balance method, adjusted balance method, or average daily balance method. But most of the lenders uses an average daily balance method, including new transaction with compounding. And the reason why they like the one that with compounding is because they make more interest on you. Okay, they earn more interest on you. You know, when they use with compounding. Okay, so even the Bank of America know that interest is the way to go. Okay, those big banks, the big creditors, they are not stupid. to earn more interest, they devise a formula that will yield more interest for them. Okay. Meanwhile, you got my competitor, that snowball group, talking up to folks, hey, you need to attack the lowest balance instead. A lot of times the lowest balance is on a low APR. Remember, low on low is no good. Okay. Why the folks over at that snowball group were telling people to go attack the lowest balance? I'm guessing because they thought, because since they are attacking the lowest balance account is obviously close to zero. And what's going to happen after they're done with that lowest balance account, whatever minimum payment or regular payment that was on the lowest balance account, they're going to roll it over to the next debt. Okay. So these folks, they were misinformed, the folks over at that snowball group, thinking that by rolling over the cash flow to the next lowest account, okay, so which in essence will give them access to cash flow sooner. So they thought having access to cash flow sooner, they thought erroneously that would get them to the finish line faster. No, having access to cash flow sooner, America, will not get you to the finish line faster. Okay, you might have some premature celebration to where you knock out accounts quicker than other people, but we're talking about our overall global accounts, our overall global debts. Okay, that is why that snowball always have a fast start, but that avalanche always catch up to them, because that avalanche doesn't have no drag. That avalanche is attacking the higher APR. Okay. So these folks, compared to that avalanche, the folks over at that snowball group will have a faster start because they'll knock out a few accounts quicker. Okay. But at some point, that avalanche will catch up to them. And at some point, that avalanche, depends on the example, will warp speed past them. Okay. So just to prove to you guys, again, having access to cash flow sooner will not get you to the finish line faster. Okay. So for years, these folks, they were misinformed. The folks over at that snowball group. Remember, at some point they used to brag that, hey, they're gonna pay off debt quicker than everybody else. Okay. They were misinformed, man. When you run the actual numbers, it wasn't until later they realized that, and then they're trying to change their tune a little bit. Psychologically, and all this nonsense that they like to talk about. Okay. Over at Ambroise Method, I've shown you multiple examples whereby even if we attack the same lowest balance account that they are attacking, okay, there is a proper way to do it. There's a better way to do it. Even if we were to do event priority on the smallest balance account, okay, we'll get that account to zero balance a lot quicker than they can. And I covered that in multiple case studies in the past. I think one that I titled Improving Debt to Income Ratio. I don't really remember, but anyways, I covered that item extensively from our past lesson, where we were attacking lowest balance account. And when we were comparing with that snowball, okay, it's going to take these guys forever to zero out an account. Meanwhile, on that particular example, it only took us one cycle to zero out that account. Yeah, I think it was improving your DTI, yes, your debt to income ratio. That was one of the lessons or one of the case studies that we talked about it. We covered that multiple lessons, multiple case studies, but for sure in that one case study, improving your debt to income ratio. Okay. So again, even the banks know that interest rate is the way to go. That's why they devised a formula so they could earn more interest on you. Okay. So, and again, the bank, they are not stupid. They know interest is the way to go. Okay. So that is the standard, America. When you're paying off debt, you always need to attack the highest APR. Because a lot of times the highest APR will yield the highest interest cost. Okay, not always, but a lot of times. Okay. All right. So going back, 6,000 income, 4,000 expense, 2,000 cash flow. So let's try to mimic what our competitor over at Velocity Banking Group is doing, because we're doing a scenario for a financial coach, hypothetical scenario for a financial coach. Okay, so 10,000 on day one. Remember, these folks, America, they like to show all of the income comes in all at once. Okay, so we're gonna show that 6,000 comes on day one, and all of the income or all of your paycheck, once it touch down the account, so the balance on that account gonna go down. So that represents a payment. Okay. Okay. 6,000 income. Okay. When you send all your paycheck or all that income into the HELOC. Okay. HELOC has a balance of 10,000 on day one. Okay. All right. Because these folks over at Velocity Banking Group, they always want to inflate the numbers. Okay? So they're going to exaggerate in the performance here. Again, not everybody, most Americans who are on a W-2, we're on regular, has a regular job, they are on a bi-weekly pay period. Okay? So all the income, America, will not be coming in all at once. If you're on a bi-weekly, or if it's 6,000 net, so let's assume the two paychecks are equal if it's only two paychecks. And some months you have multiple paychecks. That's why I have a lesson called paycheck allocations. We're going to get into that much later. It will never be 6,000 coming in all at once. Okay. The next one after bi-weekly is weekly. The next one after weekly, I'm talking about the most utilized ones, is semi-monthly. The next one after semi-monthly is monthly. Okay. Unless you want to cover a small percentage of the population. But if most of us are on a bi-weekly pay period, when you run your numbers, Velocity Banking, you need to run your numbers based on what most people have. You got it? All right, 10,000 on day one. My competitor gonna show all the income comes in all at once. So 10,000 minus 6,000, 4,000. When we're doing an average daily balance, including new transactions, there goes the new transactions, these two columns, with compounding, but without compounding on this example. Okay? Because I don't want the folks over at Velocity Banking to copy what we are doing. Okay? And again, I've already got burnt. Okay? So I'm a little more paranoid now. 10,000 minus 6 with 4,000. Okay. 4,000 was the ending balance. that becomes the beginning balance on day 2. Since we didn't have any transaction, so 4,000, 4,000. Nothing's changed. 4,000, 4,000. No new transactions. Okay. No new purchases or advances. No new payments or credit. Okay. The only income that comes in was the 6,000, and these folks show it comes in all at once. Okay. So 4, 4, 4, 4, 4, 4, 4, 4, 4, 4, all the way through. On day 27, day 27 of the cycle, financial coach from Velocity Banking wants to make a transfer, wants to make an advance, and send the money back to the checking account. Okay? This time, remember, since it's an HELOC and it was interest only, whatever the old monthly interest charge for the cycle, the bank earns the interest on you. Okay? So the only thing that really reduces the HELOC is the cash flow. Okay? So in this case, they're going to show 4,000 goes out. So from the HELOC back to the checking account. So on the purchase of new advances, 4,000. Okay? When you send payments back, funds back to the checking account, they're gonna increase the balance on the HELOC. That's why we have a plus here, plus 4,000. Here we have a minus. That was a payment. Okay? This one reduces, paycheck reduces the balance. An advance, when you send the money back to the checking account, it increases the balance. Okay? So now 4,000 plus 4,000 is 8,000. Okay? So 8,000. Then we did not have any other transaction. Okay? And this 4,000 back to the checking account. Then they're gonna use the checking account to pay off debt. Okay? Why? Because the HELOC is not that convenient. That doesn't offer convenience. I'm sorry. Okay. You cannot pay your bills, your regular expenses with the HELOC so far. Okay. So that's why they were forced to move the money back to the checking account. And from the checking account, whether you have automatic payment or whether you're gonna manually make the payment yourself. Okay. So this HELOC that the folks over at Velocity Banking go bragging about, okay, this one is not even a high performer. Not only that, doesn't even offer convenience. Because if it did, why would you be moving the money back to the checking account? So this account needs help. But to the folks over at Velocity Banking, it is a be all and end all. No. You can't even pay bills, expenses with that account. That's why you were forced to move the money back to the checking account. Meanwhile, if it was a credit card, well, you could have automatic payment taken out of the credit card. And again, these folks, they are not doing the due diligence. In the beginning, I've shown you guys how they went from a credit card to a PLOC to a BLOC to a HELOC. Meanwhile, in most examples, a credit card is a higher performer than an HELOC. So they went from something that was better in most examples to something that is worse. A credit card, America, in most examples, is a higher performer. In other words, it's a better debt weapon than a HELOC. A credit card is a better debt weapon than an HELOC. In a lesson where I've done a credit card versus a HELOC, I've already covered all these items extensively, America, from our past lesson when I did a credit card versus a HELOC. Okay? And the numbers don't lie. Okay? But these folks, because they don't fully understand this alternative account, they think a HELOC is better than a credit card. because of the way that they use that account. And the way that they use that account is to dump all your paycheck into that account, which is what? From a past lesson, we call that level 1, dumping all your paycheck. And we have up to about 6 levels. Can you imagine? You're going from something better to something worse, but you think the worst trade line is better than the best one? Why? Because these folks, they don't fully understand that, and when you're paying off debt, you're going to come across 3 main elements, 3 main assignments, 3 main jobs, and these are transfer. They call it chunk on their end. Alternative account, they call it debt weapon on their end. And cash flow. Because remember, your trade line, they're always in competition with themselves to see who gets to keep what. So who gets to keep or who gets to marry this virtuous woman called cash flow. Okay? So for chunking, a HELOC generally have lower APR than a credit card. So the chunk has to be performed out of the HELOC. So in this one, the HELOC wins. Depends on the example. Okay? As a debt weapon, for them, if it belongs to them, well, how do they use a debt weapon? They have income comes in, expenses goes out, just like we have here. Well, if you're going to have income comes in, expenses goes out, okay, you are better off to have this movement happen inside a higher APR. Well, since a credit card usually have higher APR compared to a HELOC, generally, not always. So this should be the credit card. And cash flow, this virtuous woman called cash flow is better served to go to the higher APR. And we're going to prove that a little later here. Okay? So out of the 3 items, I have credit card 2 places. So 2 out of 3. So the credit card is a higher performer than the HELOC. But again, my competitor, these folks, they are confused. So they don't fully know how to properly use their so-called debt weapon. We refer to it as alternative account on our end. So they think a HELOC is better than a credit card. Why? Because you could dump all your income into a HELOC, but you cannot dump all your income into a credit card, because not every bill, a lot of times, cannot be paid with a credit card. So, well, if that was the case, not every bill can be paid with a credit card. Well, the portion that cannot be covered with a credit card, well, you let it remain inside the checking account. So it'll be a combination of a credit card with a checking account. Just like you guys still doing a combination of an HELOC and a checking account. So HELOC, at some point you move the money back to the checking account. So you're using a checking account. Someone who uses a credit card could use a checking account as well. And not only that, I'll prove to you guys from past lessons that a credit card is a higher performer. So it's a better debt weapon than a HELOC. So this confused bunch over at Velocity Banking Group, not only they're confused, now they start copying what we are doing over at Ambroise Method. And again, folks, over at Ambroise Method, we lead, we do not follow. Anyways, going back to the lesson. All right, 6,000 goes in, reduce it to 4, and on the 27th, they've executed some advances. They move the money back to the checking account. So 4 plus 4 is 8, so that's why we have 8 here. 8 is the ending balance. 8 becomes the beginning balance here. So we had no other transaction. 8, 8, 8, and It hit here, hit here, hit here, hit here. Okay. And again, folks, because the bank uses average daily balance, including new transaction with compounding. Okay, but in this case, we're using without compounding. The way they arrive at the average daily balance, they add all the ending balance divided by the number of days in a cycle. Okay. This is all the ending balance for day 1, day 2, day 3, day 4, day 5, all the way to day 30. Okay. So let's see how many 4,000 we have. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. 1, 2, 3, 4, 5, 6. So we have 26 times 4,000. Okay. So 26 times 4,000. Okay, let me run that real quick. 26 times 4,000. So I'm at 104. Okay. Then we have 8,000. How many 8,000s we have? We have 1, 2, 3, 4. So 4 times 8,000. Okay. So we're trying to educate the folks of our Velocity Banking Group how this thing works. 4 times 8,000 is 32. When you add them up, 104 plus 32. That's how we arrive at 136,000 that we have on the board. And again, folks, the way they arrive at the daily balance, average daily balance, is to add all the balances. When you add all the balances, you're at 136,000 divided by the number of days in the cycle. And the number of days in the cycle, since my competitor always uses 30 days, so that number divided by 30 days. So 136,000 divided by 30. So we are at $4,533.33. Okay. 136,000 divided by the number of days. We are at $4,533.33. Okay? That's the average daily balance. For a lender who is using an average daily balance, including these new transactions, without compounding. So we have without compounding here. Later on, we're going to do with compounding. Okay? Because I want to make sure I bring everybody along so I don't lose anybody. Now, the average daily balance, if the average daily balance is $4,533.33, when this group keeps the cash flow, okay? If $6,000 of income comes in, only $4,000 goes out. That means inside that account, $2,000 stays inside that account. Because we had 6 total, but only 4 went out. Okay, 6 minus 4, we have $2,000 in cash flow. So over here, they kept the cash flow. HELOC keeps cash flow. And the cash flow was 2,000. Okay? All right, America? Now, so what is then the monthly interest cost for the cycle? The monthly interest cost for the cycle. The way they arrive at the monthly interest cost for the cycle is to convert the APR to a daily. So 9%. So 9 divided by 100. So 9% 9 divided by 100. And let's assume this particular lender uses 365 days. So divided by 365. Okay. So now we are at 0.0002465 753. Okay. That is the APR converted to a daily. 9 divided by 100 divided by 365 if the lender is using 365. Because you have some lenders that might use 360 overall, 360. Or some might use 366 on a leap year. But right now we're in 2025. 2025 is not a leap year. Okay? So 365. So you'll be either 360 or 365 in 2025. Okay? But this particular lender uses 365 as opposed to 360. Okay? And since we're not in a leap year, we're not even talking about 366. Okay? So we've already converted the APR to a daily. Okay? The reason why I'm going a little slower because I know some folks wants to have that kind of knowledge. Okay? So the average, the APR converted to a daily times the average daily balance. We found out earlier the average was 453333. And again, it's 136,000 divided by 30. So 453333. Okay? Interest rate converted to a daily times the average daily balance times the number of days in the cycle. And the cycle is 30 days. Okay, America? Now you have some other lenders that might use the average daily balance times, instead of the daily periodic rate, they're going to use the monthly periodic rate. Okay? And sometimes this changes, depends how many days we have in a month. Because some are 28 days, 29 days, 30, 31. Okay? So, and again, our government allowed these big banks, these big creditors to do whatever they want. Some of them might do, let me put down on the board, an average daily. So you might do average daily times the daily periodic rate times the number of days in a cycle. You have other lenders that might use an average daily. This time they're not going to do a daily periodic rate times the number of days of the cycle. They're going to do a monthly periodic rate. Okay? So between two lenders, the results might be different. Okay? Because you have some that use a flat 20, 30 days. You have some, the cycle might be 28, 29, 30, 31. So if somebody's multiplied something by 30, meanwhile someone else is only multiplied by 28, so there might be a change. You multiply by 30, but someone's multiplied by 29, there will be a change. You multiply by 30, but someone else is multiplied by 31, so that might be a change. Okay? So you got some, again, average daily times the daily periodic rate times the number of days. You have others, average daily times the monthly periodic rate. Okay? Just the monthly. Whatever that is. And there will be a change because not every month has the same number of days. Okay? Or anyways, going back to our example. So let's figure out what the monthly interest cost for the cycle would be. Okay. So 0.0002465 753 times 453333 4533.33 times 30 days. Okay, so now we are at, put that down here, 3353. That would be the interest cost for the cycle. After you have, let me use their terminology, after you have income comes in, expenses goes out. Okay, so now you ended up with an interest cost of $33.53. Let me run my numbers one more time, making sure I did not make any mistake. $33.53, perfect. Okay. So, and again, the way they arrive at the monthly payments charge, average interest rate converted to a daily times the average daily balance times the number of days in the cycle. That's how we got $33.53. Okay. All right. That was the way that my competitor usually go about things. They always show that all the income coming all at once. Okay. And to help them out, we put the income on day one. Okay. And for them, they always use an average. Okay. Because these folks, they don't know how to properly compute the thing, so they're always using an average. If you ask them, well, what's the interest cost for the cycle would be, they won't be able to tell you, at least most of them. They'll tell you, well, it'll be about that amount, because they're using an average. Okay? For us over at Ambroise Method, we use actual numbers. Okay? So 3353. Okay? When they use an average, you'll never be 3353. All right. Earlier, America, I mentioned to you guys that dumping all your income into a HELOC is the wrong thing to do. Okay. So I'm going to show you a better way. Okay. This is why we have this column here. Okay. Now, since these folks are showing that on day one, $6,000 comes in, so the entire income comes in on day one. Okay. So we're going to show $6,000 comes in. All the paycheck comes in all at once. Which is one of the silliest things I've ever heard. When we're on a bi-weekly pay period. Most of us. So 10,000 minus 6,000 all income comes in, all your paycheck. So we had 4,000. 4,000 ending balance becomes beginning balance because we're doing the formula, the calculation for without compounding. So we did not have any new transactions, America. So 4,000 all the way through, 4,000 ending balance, 4,000 beginning balance. 4,000 plus 0 or 4,000 minus 0 is still 4,000, okay? On day 27th, okay, this time, instead of sending 4,000 back to the checking account, we're going to send 6,000 back to the checking account. And that 6,000 includes whatever the minimum payment was on the HELOC itself because the bank earns the interest on you. So 6,000. back to the checking account. Okay? Oh, I'm too high. 6,000 back to the checking. Okay? All right, America. So now, going back to our chart, 10 minus 6, we're at 4. We did not have any new transactions, so 4 all the way through. On day 27th, financial coach from Velocity Banking decided to send all the money, or in this case, it wouldn't be them, it will be us. We decide instead of sending 4,000 back to the checking, we'll send in 6,000 back to the checking. Okay? So 4 plus 6 is 10. We did not have any new transactions, so 10 here is the ending balance. 10 is the beginning balance. 10 plus 0, we still have 10. 10 minus 0, we still have 10 because we didn't have any new transaction, whether it's purchases or additional payments. Okay? And we refer to that scenario, America, when we have the same dollar amount of income that comes in, when we have the same dollar amount of expenses that goes up. Okay? It is a technique that I devised and I named it Ambroise's wash technique. America, over at Ambroise Method, we are truly a different kind of talent. Nobody's teaching you about that stuff beside us over at Ambroise Method. That was something I covered from past lessons. Ambroise's wash technique is a technique whereby the same dollar amount of income that comes into the alternative account is the same dollar amount of expenses that goes out of the alternative account. 6,000 goes in, 6,000 goes out. It's a wash. They are equal. Hence the name Ambroise's wash technique. Okay? So in the HELOC, you're going to dump all the income in the HELOC. Okay? But since the HELOC still have a little bit of availability, remember 10,500 minus 10,000, not taking into account the monthly payments charged. So we still have 500 bucks available in the HELOC. Okay? So we could have a full absorptions in that HELOC. We could have all the income going in and all the expenses going out. Okay, America? Now, let's do our calculation now. How many 4,000s we have? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. 1, 2, 3, 4, 5, 6. We have 26 times 4,000. 26 times 4,000 is 104. This time we don't have 8,000, we have 10,000. So how many 10,000 we have? Because 4 plus 6 is 10. Over here, 4 plus 4 is 8. Okay? So we have 1, 10, 2, 3, 4. 4 times 10. Remember, we have 30 total. 26 plus 4 is 30. Okay? 4 plus 10, 4 times 10, we have 40. When we add up all the balances, 104 plus 40, we're at 144. That's how we arrive at 144 over here. Okay. Again, folks, I'm going a little slower because I do not want to lose anybody. Okay. 144 divided by the number of days in a cycle. We had 30 days. So 144 divided by 30, 4,800. Okay. So when the HELOC keeps the cash flow, we are at 453333, 453333. When we employ Ambroise's wash technique, the W for wash, we are at 4,800 for average daily balance. This is for without compounding, okay? Now, if the average daily balance is 4,800 over here, okay? So what would be the interest charge for the cycle? Because remember, we've gone a different route, okay? So the way they arrive at the monthly interest cost for the cycle America, it is the APR converted to a daily. So 9%, 9 divided by 100 divided by 365, since this lender is using 365 days, we are at this number, 0.0002465,753, okay, times the average daily balance. Why we say the average daily balance? This time it's 4,800. Times the number of days in a cycle. 30 days. 1 through 30. 1 through 30. Okay. Now, when we add them up, when we multiply 9% divided by 365 times 4,800 times 30 bucks. So now we are at 35.51, because we're gonna round up. That's the interest cost. Okay. If we go the normal way that our competitor Velocity Bank can do things, the interest cost for the cycle would be $33.53. $33.53. Which represents, let's see how much that represents. That represents 4.0236. So this will give them an effective rate of 4.0236. I see somebody doing that, you know. So I was not the originator of this thing. So 4.0236%. So for dumping all the income into the account, and that expense goes out while keeping the $2,000 cash flow for 3 months, 6 months, 9 months, 1 year. Depends how long it's going to take them to amass enough cash flow so they could execute the next chunk. Okay? The effective rate right now will get reduced from 9% to 4.0236. Not bad. Not bad at all. Okay. Over here, 3551. Let's see what the effective rate is over here. $4.2612. Okay. Now, and again, you went from 9% before movement, before income, let's use their terminology, before income comes in and expenses goes out, to 4.2612 over here to 4.0236. Okay. So as you could see, when they keep the cash flow 3353. Over here we do not keep the cash flow because we plan on sending the cash flow somewhere else. Okay. We had 3551. So over here they save more on interest. Their interest cost is less over here. Their interest cost will only be 33. Our interest cost when we go a different route gonna be 35. Okay. Over here their effective rate is 4.0236. Little smaller. Our effective rate is much higher, 4.2612. Okay. So the point is, even in America, when you have in movement and the numbers are still the same, 6,000 here, 6,000 there, over here we did not keep the cash flow, just like they kept the cash flow, that $2,000 cash flow. Our effective rate in America is still gonna get reduced from 9% to 4.2612. Okay. Now, the interest cost is where it matters. So their interest cost 3353. Our interest cost, if we go a different route, 3551. Okay. So let's see how much they were able to save. So 35. Put that a little higher. 3551 minus 3551 minus 3353. Okay, let's run it. 3551 minus 3353. A difference of $1.98. You see that? So, America, over here they kept $2,000 inside the account. Over here we did not keep $2,000 inside the account. We sent everything out. 6 goes in, 6 goes out. The difference compared to us is only $1.98, less than $2. So on $2,000, they were able $2,000 extra, 4,000 here because 6 minus 4 is that 2,000. Okay, so they kept $2,000 extra. They only have a depressing savings of $1.98 compared to us. Okay, and again 3551 for us, and interest cost 3353 for them. 3551 minus the 3353, so They're ahead of us by $1.98 on 2,000 bucks. Okay? Now remember, the $2,000 remain inside the HELOC. Because if you kept $2,000 in it, the balance on the next cycle will be $2,000 less. Okay? And that 2,000, since it stays inside the HELOC, it represents a payment. And what do payment do? Okay? So, on the HELOC, they were charging 9% for each dollar borrowed. They're charging you 9%. America, the reverse is also true. For each payment made, we are also saving 9%. Remember, we're keeping 2,000 inside the HELOC. That represents a payment. So 2,000 at 9%. Divided by 12 if we want to break it down per month. And we're using a simplified formula. Or a simple formula. So 2,000 times 9% divided by 12. So we are at 15 bucks. So combined, it is the 50 bucks that they're saving for keeping the 2,000 inside that account itself, because now the balance is going to be $2,000 less. Okay? And again, on the HELOC, they're charging 9% for each dollar borrowed. Okay? Before any movement. So for each payment made, before any movement, we're also saving 9%. Okay? So that's 15 bucks. So 15 plus $1.98, we are at $16.98. Okay? You see that? So in addition to all the saving from reducing the interest from 9% to 4.02, but just like they reduce it, we reduce it. But the difference between the interest cost is only $1.98 between them and between us. If we go a different route. Okay? So $1.98 plus the 15 bucks, since they keep the $2,000 cash flow altogether, compared to us, they'll have a saving of $16.98. You see that? Now, remember, for us, 6,000 goes in, 6,000 goes out. Well, the expenses was not 6,000. The expenses were only 4,000. So after we pay all the expenses, including whatever minimum payment or regular payment on the HELOC itself, okay, for the cycle prior, okay, so 4, expense was only 4, but we sent out 6. So where does this extra $2,000 went to? This extra $2,000, we're gonna send it to any account that has the higher APR. And we take a look on the board, we have 2.65, 9%, 18%, and 30%. The account with the highest APR is the secured personal loan, 30%. So that's where we're going to send the $2,000 to. So when the money touched down the checking account, after we pay all our expenses, which was only $4,000, the checking account going to have an additional $2,000 bucks, America. That additional $2,000 bucks, we're going to send it to the absolute highest APR for maximum interest savings. So now 2,000 will go to the secured personal loan at 30%. 2,000 times 30% divided by 12. And again, on the secured personal loan, they're charging us 30%. Okay? So for each dollar borrowed, they are charging us 30%. The reverse, America, is also true. For each payment made, we are also saving 30%. Thank you, Jesus. Thank you, Lord. So 2,000 bucks, America, times 30% divided by 12. So 2,000 times 30% divided by 12. We are at 50 bucks. Even if we were to send it to the credit card, okay? We will not be sending it to the credit card because the credit card has a much lower APR, but let's just, so this one is the personal loan. Let's say this one is the credit card. So it'll be 2,000 bucks times, and the credit card, they're charging 18% for each dollar borrowed. The reverse is also true for each payment made. We are also saving 18% before any movement. So times 18% divided by 12. Okay? So 2,000 times 18% divided by 12. We are at 30 bucks for the credit card. Okay? This one is for the personal loan. Okay? So, over here on the personal loan, we're having a greater savings than if we send it to the credit card before any movement. Okay? Now, let's compare the results with our results. For their results, they have $1.98 additional. Because we were at 35 here, they were only 33 there. Okay? So $1.98 plus 15 bucks that they are saving before any movement. So we're at $16.98. Okay? So they're saving, in addition to reducing the effective rate, they have a net saving of $16.98. Okay. For us, because we've gone a different route, we employ Ambroise's wash technique, 6,000, 6,000, so we could send the cash flow somewhere else. Where? To any higher APR. Higher than 9, where 18 is higher than 9 or bigger than 9, 30 is higher than 9 or bigger than 9. But since 30 is the highest one, we're going to pick 30. Okay? Our saving is 50 bucks. Even on the 18% one, our saving will be 30 bucks. So, these folks, they are saving $16.98, so less than 17 bucks. We are saving, in addition to all the savings, other savings, we're saving an additional 50 bucks. Which saving is bigger, America? $16.98. Let's call it 17. 17 here. 50 there. For the cycle. Or for whatever cycle. 17 here. 30 there. Even if we were to send the cash flow to the credit card, we'll do better than these guys. 30 is bigger, better than 17 bucks. $50 savings, interest cost savings, in addition to all the other savings for having movement. 50 is bigger or better or greater than 17 bucks. So, the folks over at Velocity Banking Group, these folks do not properly know how to use this so-called debt weapon or debt tool. Because again, the only way they know how to use that account is to dump all the income, all the paycheck into that account. And since all income includes cash flow, so they're going to keep cash flow inside that account for 3 months, 6 months, 9 months, 1 year. Okay. For us, we don't keep cash flow in a 9% account. Okay. After we take a look at the effective rate, we send cash flow to the next account, okay, where we'll have greater results in terms of reducing interest cost or in terms of interest savings. That is why the folks of our Velocity Banking Group, they'll never ever be able to compete with us. Because on the debt weapon itself, alternative account for us, okay, we've already surpassed their results. And again, the number don't lie. 60.98 in savings versus $50. 60.98 in savings versus $30. Okay? We don't keep cash flow inside our account for 3 months, 6 months, 9 months, 1 year. Okay? Remember, America, you wait, you lose. Okay? As soon as you have the cash flow, send it to the proper account. And we've determined that the personal loan was the proper account because the APR on the personal loan was not just higher, but considerably higher than the interest rate on the HELOC. 30% is considerably higher than 9%. That is why the saving is so large, 50 versus 17 per cycle, which is quite a bit. Okay? Which is quite a bit. Spirit of Father, thank you. All right, America, I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America. And this was without compounding. And again, folks, I apologize. I did not want to put my formula, my proprietary formula, Excel formula for average daily balance, including new transaction with compounding, because I don't want my competitors to start stealing it or to start copying it. So that's why I have without compounding. So now let's do the results for with compounding. Okay? So when I open up my proprietary calculator, let me do that right now. Put in my password. I've already done it, but I just want to double check my numbers, making sure I did not make any mistake. Okay. So if it's with compounding, this is with compounding, and that's supposed to be the results. But let me double check my results. 9%, 10,000 previous balance, previous day balance, 10,000. 6,000 goes in on day 1. 4,000 goes out on, as for this one, 4,000 goes out on day 27. So the result should be 3366. So this one is without compounding, and this one will be with compounding. So with compounding, we are 3366. That's the interest cost. 3366. Okay. And that's the interest cost, and the average daily was 455034. 455034, perfect. Okay. Now let's go on that section. 6,000 goes in, 6,000 goes out. So I already have 6,000 coming in. The only change is this one from 4 to 6. So 6,000 goes in. Let me change that to 6,000. Comes out. Okay. So the average daily is 4,800. With compounding. Make sure I did not make a mistake somewhere. 10 minus 6. 6 goes in, 6 goes out. So without compounding, I'm at 4,800. With compounding, I'm at 48, 17, 10. 48, 17, 10. Perfect. So my numbers are perfect, which will give us an interest cost of with compounding over here we have an interest cost of 3,563. 3,563. Okay, so now let me double check my numbers. Remember, it is the APR converted to a daily 0.0002465,753 times the average daily balance. So we have average now 4,553.4. 4,553.4. 53.4 times the number of days. The number of days was 30. So let me run it, making sure we are at 3,366. So 9% divided by 365 times 4,553.4, which is the average daily with compounding when we keep the cash flow. 4,553.4 times 30 days. Sure enough, 3,366. Okay. Okay. Now over here, let me make sure everything is good. So we are 0.0002465,753 times the average daily. The average daily for these guys are 481710. 481710 times 30 days. Let's see if we are at 3,563. So 9 divided by 100 divided by 365 times 481710. 481710. 481710 times 30 days. Sure enough, 3,563. 3,563. Okay? So our numbers are perfect with compounding. With compounding. Okay? The interest cost, 3,366. The interest cost, 3,353. Only 10 cents difference. See, the reason why they like to use with compounding, like I mentioned earlier, they make more interest on you. Okay? 3,366 is more than 3,353 in that category. Okay? Remember, 10 cents over a bunch of clients that they have, that's a lot of money. 10 cents, that's more than 10 cents. That's 13 cents. Okay? 6 minus 5, 3. Yep. That's a lot of money that they're making. Okay? Don't look at it like it's only a few cents. Okay? Over here, with compounding, we are 3,553. It was 3,551. Now it's 3,563. 3,563 minus 3,551. 12 cents extra. 12 cents times a bunch of clients that they have. So they're making a lot of money. Okay? Even at 12 cents extra. So as you can see, they make more when they use the formula with compounding versus the formula without compounding. With compounding yields them more interest. So they earn more interest on you. That's why they prefer the formula that includes with compounding. Because with compounding, that's interest added on top of interest, for lack of a better term. Okay? All right? And like I mentioned earlier, even the banks, they are not stupid. They know what to go for. They go for the ones with compounding. Okay? That is why sometimes I pity the folks over at that snowball group talking about to attack the lowest balance. And some factions of Velocity Banking Group as well. Because some factions of Velocity likes to attack the lowest balance just like that snowball. Okay? The banks know exactly where to go, which formula to use, what's important. Okay? So don't make that mistake, America. All right? Now, if interest cost is 3366, okay? So, and interest cost is 3563. Okay? So, over here in the formula with compounding, this group is doing better. Less is better. So the interest it's costing them on that side is only 3366. The interest is costing us on this side is 35. Okay. All right. So we're paying more interest over here. Well, how much is the difference? Well, let's find out. 3563 minus 3366. Alright, so now let's run it. 35.63 minus 3366. Okay, we are at $1.97. Okay, without compounding, it was only $1.98. With compounding, the numbers are about the same. $1.97, $1.98, $1.97. Okay, so if you're staying consistent, okay, whether it's without compounding or with compounding, there isn't any major difference. Okay, so don't think you guys that you are missing out because I did not put the formula with compounding. And like I aforementioned, I do not want my competitors to steal my formula. That's why I don't put the formula on the board. I put the one without compounding on the board. Okay. So for those of you who are expecting to see that formula, because it's not readily available online when you Google it, okay. So I apologize to you guys, but I understand why I'm doing it. Okay. I'm getting a little paranoid because since the folks over at Velocity Banking Group start copying or emulate what we are doing over at Ambroise Method. Okay? So I hope you guys understand, okay? So for that, I apologize, okay? All right. So $1.97, 20,000 at 9%, 12%, still 15 bucks. Because remember, they keep 20,000 over here. 9% divided by 12, 15 bucks. So over here, it'll be $1.97 plus 15. We're at $16.97. That's the without compounding. Okay. How about the same? $16.97, $16.98. Only 1 cent difference. Okay. But again, we're going to send that 2,000, instead of keeping it on the one without compounding, we're going to send it to one of these accounts. We have 50 bucks. Even if we sent it to the credit card, we're at 30 bucks. So $16.97 versus 50 bucks. $16.97 versus 30 bucks. That is why, again, America, we do not keep the 2,000 cash flow inside the HELOC. Okay? So, one way to do better than these folks over at Velocity Banking Group is to employ Ambroise's wash technique and send the cash flow somewhere else. Okay? Again, greater saving. 50 here versus 1697. 50 here versus 1698. 30 here versus 1697. 30 here versus 1698. Over here, we're having greater savings for sending the cash flow somewhere else. And again, 6,000 goes in, 6,000 comes out. But the expense were only 4,000. That means there's going to be an additional 2,000 inside the checking account. Okay? So from the checking account, remember our own trade lines, America, are always in competition with themselves to see who gets to keep what, to see which account gets to keep what. So in this case, we're trying to figure out where to send the 2,000. They're always in competition with themselves. So we know we're going to send the 2,000 to the highest, the absolute highest APR, which is the secured loan, 30%. Okay, America? That's how you do better than these folks over at Velocity Banking. Okay? And by the way, this was not Ambroise Method. Okay? For us over at Ambroise Method, we'll still employ Ambroise's wash technique, but it will not be that way. We'll still have better results than what we have on the board. Okay? Because on our method, we recognize that a credit card is a higher performer than an HELOC in terms of reducing interest cost. Okay? So we use the credit card first. And after the credit card is used up, which means 1,900 could go on a credit card, plus the minimum payment on the credit card itself. Okay? So after we have these two amounts going into the credit card, okay? At least that one, 1,900, because we'll see if we could absorb part of the 597.80 to send it to the higher APR secured personal loan. Okay? So after the credit card is used up, then we'll start thinking about the HELOC, because we fully understand on our method which one is a higher performer, which one is a better place, okay, to pay our expenses from. Okay? You'll be better off paying your expenses from the credit cards for bills, expenses that could go on a credit card. In our example, 1,900. Okay, America? Now covered that extensively from our past lessons and our case studies when we're running Ambroise Method. Okay? This is what to show you guys quickly what to do. Okay? That is not Ambroise Method. We're still going to employ Ambroise's wash technique. We might, but in a better way, okay, when we do Ambroise Method. Okay. And again, America, as you could see, okay, we don't blindly do things over at Ambroise Method like these folks are doing. Income comes in, expenses goes out. Okay? They're really not thinking about the numbers. Okay? Okay. Because so far they haven't proven to have the capacity to properly analyze things. Otherwise, they wouldn't be doing this nonsense that $6,000 of income comes in, $4,000 goes out to pay expenses, including whatever minimum payment or regular payment on the HELOC itself. Because remember, again, the bank earns the interest on you. Okay? For us, we like to analyze things first. Okay? Not only that, we already have a pretty good idea because we've been at it for a little bit. Okay? We know that 4,000 should not go. Not only 4,000 should go up. Okay? 6,000 should go up. because we're gonna have better results if we send 6,000 out as opposed to just 4,000. Okay, we do not keep cash flow inside a 9% HELOC for 3 months, 6 months, 9 months, 12 months. And again, folks, you wait on the cash flow, you lose. Okay, don't try to hijack the cash flow for 3 months, 6 months, 9 months, 12 months. Okay? Don't you ever do any silly things like that, America. Okay? Because as you could see, you are going backwards. And again, the numbers don't lie. 1697 versus 50. 1697 versus 30. 1698 versus 50. 1698 versus 30. Additional savings after movements, after the effective rate. Okay? Is these folks took their time to run the numbers. Okay? Then they will never do this nonsense that income comes in, expenses goes up. Okay? So for us, 6,000 will not even go in. We're not going to dump all our income into that account. We're going to dump only whatever portion we figure should go on that account. Because as you could see, any extra income or any extra cash flow or any extra paycheck would be better served to go somewhere else. For us, it will never be 6,000 touched down the HELOC. Okay? Which is what I refer to as level 6 from one of our examples. Okay? These folks, this account will not be level 1 for us, let alone all the way up to level 6. Depends on the example. Sometimes you might have 4 levels, 5, 6, maybe more, because again, I haven't done the formula for every single scenario. Okay? But at least I've done it for one, and we arrive at level 6. Okay? All this HELOC will get to keep is just whatever minimum payment. So we could satisfy the minimum payment, whether it was 3353 if we're using without compounding, or 3366, since most lenders using 3366, 3366. Okay. Plus whatever bills, expenses that could not be paid with a credit card. Okay. So 3366 plus the expenses, and then at some point the expense is gonna go up. Okay. It's just gonna temporarily touch down the HELOC. I'm talking about the portion that the credit card could not cover. Okay. All right, America. I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America. Another mistake that my competitor is making, start erasing, let me erase this one instead. Let me go here. Is that a lot of times these folks are telling the client to go acquire a new HELOC or a new PLOC. But not once they've taken into account whatever cost that you were forced to pay for acquiring a new HELOC. Because remember, you don't just get a HELOC or get a PLOC. Okay? There are fees associated with the HELOC with a PLOC. Okay? So now once these folks take into account how long it's going to take to recoup the fee that you were forced to pay. Okay? They're not just going to give you a HELOC. Whoever the lender is, or the creditor gonna charge you fees. Okay? Same thing with a PLOC, or most PLOC, but for sure on an HELOC. Okay? If they waive the fees, at least you have some other stamps for the county where the property is located. And most of these counties, you know, with those commissioners, you know, that's one of the form of revenue. Okay? You know, because we have some kind of stamps that you have to pay and some other fees that the county itself or the city, wherever the property is located at, you know, that they charge. At least in the area where I'm from, okay, they have those fees. Not only that, those banks usually charge fees in addition to all those stuff. Okay, so it's not gonna be for free. No matter how you look at it, the HELOC will never be free. Okay, so whatever cost that you're incurring, okay, you have to take it into account. How long it's going to take to recoup the cost. Okay. And my competitor never include, for all the videos I've been watching, telling you to go and get a HELOC, get a PLOC, but they never, you know, incorporate the fee that you were forced to pay. Okay. Which is wrong. Okay. Because where did the money come from? The money has to come from somewhere. Okay. So whether your income gonna be less or your expense is gonna be more, you have to account for that expense, the additional expense in acquiring that account. Okay. And earlier we talked about how a lot of times, you know, you don't need to go out there and get an HELOC to pay off debt. No. In some applications, yes. You don't need to go get a life insurance to pay off debt. You don't need to go out there and get a PLOC to pay off debt. You don't need to go out there and get a all-in-one loan, first in HELOC to pay off debt, whether he has a two-way sweep. Again, folks, we've gone over all these items extensively from our past lessons. Okay. So go back and watch these past lessons. Okay. So I'm not a YouTuber. I'm not going to take so much time trying to edit stuff, trying to add links and do all. No. Maybe when I become a YouTuber, I might do that stuff. You know. Now, earlier we talked about how these folks like to say that a line is better than a loan, and we briefly touched on that earlier. A line is better than a loan. You know, all those catchy phrases. A line is better than a loan. Okay, it's a debt destroyer. It's a debt tool. It's a debt weapon. It's a line. It's a credit line. You know, all catchy phrases. You know. These folks, they spend so much time, the folks over at Velocity Banking Group, to come up with catchy stuff, catchy phrases, catchy names, okay? But if they could channel some of their energy or their effort into learning how interest rate works, or how to properly read an amortization schedule, okay? That would be much better, okay? Don't think about little catchy phrase, line is better than a loan. It's a credit line, it's a line, it's a debt destroyer. Okay? No. Learn how interest rate works. Learn how to properly read an amortization schedule. That's what you need to do. Okay? The folks who are living paycheck to paycheck, they're not concerned about all the silly names we keep coming up with. Okay? Again, no consensus. All these folks teaching about velocity banking, all of them got a different name for this thing. It's a line. No, let's call it a credit line. No, let's call it a debt weapon. No, let's call it a debt tool. No, let's call it a debt destroyer. Again, we are living paycheck to paycheck, man. Okay? The regular Janes, the regular Joes. Okay? Show us a way to get out of debt. So now let's talk about this line better than a loan. So a line versus a loan. These people are terrible, man. Let's use this example. We have the HELOC 9%. When since it's a HELOC, we have a credit card to 18%, which is also a line, but these folks that prefer debt repayment, we prefer debt weapon is a HELOC. Since we have a HELOC on the board, okay, they will always choose the HELOC over the credit card, okay? Why? Because they are misinformed. So, since they're gonna pick the HELOC, so let's say the HELOC is the line that they're talking about, okay? This HELOC, 9%. Let's pay attention to the APR. Sometimes the APR will be higher. So let's put on the board so I could teach on, make the distinction for them. When the APR is considerably higher, let's put that right here. APR considerably higher. And we're gonna do one when the APR is considerably lower over here. Let's see right here. So line versus loan. When the APR on the line, APR on line, on the line is considerably this time lower. Okay? The line versus a loan. When the APR on the line itself is considerably higher. Okay? A line versus a loan. When the APR on the line itself is considerably lower than the loan. Okay? Well, considerably lower. Let's see if we could help these folks out a little bit. Because some of them meant well, they're just misinformed. I'm talking about some of the folks over at Velocity Banking Group teaching about Velocity Banking, or some of their followers. Let's see if we could help them out, America. Okay? America, when you're paying off debt, you're gonna come across three main elements, three main assignments, three main jobs. And these elements, these assignments, these jobs are transfer. Okay. Transfer for us, for them, since we're trying to educate them, they refer to it as chunk. So transfer for us. Let's put transfer for us. Let's put chunk for them. Okay? We have alternative account. For us, and since they have multiple names for this alternative account, I don't even know what to call it because they don't know what to call it. I don't know if I need to call it a line. Well, since we have line here, let's call it a line. Well, since most of them are familiar with debt weapon, let's call it. So let's put debt weapon. Because you know what? Since we're doing line versus loan, I'm confused. I don't even know what to put. Let's put a line. Because we're doing line versus loan. Okay. So transfer alternative account and cash flow. So we have cash flow. They have cash flow. And same thing here, we're gonna do T for transfer, A for alternative account, and C for cash flow. For them, they refer to it as a chunk. They refer to this as a line. But this time, so we could bring everybody on board, we're gonna put down debt weapon this time. And cash flow here, cash flow there for them. Okay. These are the three jobs. Checking for them, debt weapon for them, or line for them, and cash flow. Okay. Now, a line versus a loan. When the APR on the line is considerably higher, with regards to the chunk payment, to chunking, okay, APR is considerably higher, and whatever loan that we have on the board, if the APR is higher on the line, which means the APR is lower on the loan. Okay, so for chunking, the line is no good, so not good for chunking. So not good for chunking. Okay? Because you're not gonna make a transfer from a HELOC and remember the loan is lower because the line is higher over here. You're not gonna try to make a chunk payment like this 10,000 and try to lower this 44. Okay? So you'll be going backwards because remember the effective rate earlier was, what was it? 4 point something, but let's run it real quick again. This time with compounding. So we had 3366 this time. Let's see what the effective rate is. This time the effective rate will be 4.0392. Okay? Because if we do 10,000 times 4.0392 divided by 12, 4.0392% divided by 12, sure enough, we would be at 3366. Okay. All right. So if we arrive at an effective rate of 4.0395, 4.0395, America, is still worse than 2.65. You see that? So we're not going to try to transfer from a 9% to a 2.65 because even after we have movement of income and movement of expenses, the way that they go about their business, the effective rate is only going to be 4.0392. 4.0392 is still a worse interest cost than 2.65. Okay? You see that? Because 2.65, 44,680.78 was the balance, so 44,680.78 times 2.65% divided by 12. 44, where am I? Where am I? Oh, right here. Oh yeah, but by comparing apples to apples, it would have been only on 10,000, sorry. So 10,000 times 2.65% divided by 12. So it would be at 22. Okay. Here the interest cost on 10 grand now. On 10K, the interest cost will only be 2208. Well, let me put that somewhere else. On 10K at 2.65%. on that portion itself, that chunk portion itself, 2.65%. Okay, 10K times 2.65% divided by 12. So we'll have a savings of 2208. Okay. So we're not going to try to save 2208 so we could get charged 33. Okay. Saving 22 to get charged 33. Okay. To get charged $11 more. That would not make any sense. Okay. So anyways, so chunking would not be advisable to do here. Okay. When the APR on the line is considerably higher. Okay. Because even after movement, it got reduced to 403. 403 is still worse than 2.65. 403 is still bigger than 2.65. We don't want to get charged a bigger interest rate. We want to get charged a much smaller interest rate. We want to have a much smaller interest rate. Okay? So, on the chunk portion, it would not be good to move this 10,000, if we had a starting point of 0, or later on when they're amassing enough cash flow on the HELOC, okay, to send it to a 2.65. Okay? So as far as chunking, the line will be not good for chunking. So this HELOC will not be good for chunking. As far as the alternative account, comparing with the loan now. Well, in the alternative account or in the line, you could have income comes in, expense goes out. In the loan, you could have income comes in, but you cannot have expense go out. Okay? So a line is better than a loan. So this one, the line is not, this one's no good. This one, the line is good. Okay? And as far as this cash flow, well, remember the line as an APR that's considerably higher. Cash flow is better served to go to the higher APR. We're comparing a line with a loan now. Okay? When the line has an APR that's considerably higher, so cash flow will go to the line. So they have no good, good, good. So no good, good, good here. Okay? That's when the APR is considerably higher. Now, same thing, a line versus a loan, when the APR on the line is considerably lower. Okay? Now, let's see which one is lower. Okay? The line is lower, the loan is higher here, 30%. When the line is lower, okay? With regards to chunking, the line is good to chunk. Okay? So you're going to make a chunk payment from the line to the loan. That loan is at 30%. Okay? For maximum interest savings. In essence, you are exchanging a 30% for a 9%. Okay? Because when you make the chunk payment, the balance on the loan gonna get reduced by the amount of the chunk payment. And the HELOC gonna get increased by the chunk payment. In essence, you are relocating whatever chunk amount from the loan to the line. Okay? Which is a good exchange. Okay? You much rather get charged 9% as opposed to 30%, because over here for each dollar borrowed they're charging you 30%. Over here for each dollar borrowed they're charging you 9% before any movement. So before income comes in and expenses goes out. Okay? So for chunking, good. You want to chunk to higher APR account. So you would want to chunk to the personal loan. Okay. Now as far as the debt weapon, compared with the loan now, okay, the APR on the line is considerably lower. There goes 9 is lower than 30. Okay. As far as the debt weapon, well, on the line, income could come in, expenses could go out. On the loan, income could go in, expenses cannot go out because you cannot pay bills or expenses with a personal loan. So for that reason, a line is better than a loan. with regards to the alternative account for us, or the so-called debt weapon or line or credit line or debt destroyer for them. Okay, so this one is good. Okay, and as far as cash flow, well, cash flow is better served in the account that has the highest APR. Okay, if after you do movement, you still cannot make up for that high APR. Okay, so 9%, even after movement only reduced it by 4 to 4.03, less than 5%. Okay, the difference was more than 5%. 30 minus 9, that difference is like what, 21? 21 minus is more than 5%. Even if you were to go crazy with it, say 9%, let me see. If we arrive at an effective rate of 4.03, which means we're saving 4.0392, 4.96. Even if you do 9% plus 4.96, that's just 4.9, let's just call it 5%. 9 plus 5 is only 14. Even if you were to go crazy with it, 14% is still smaller than 30%. So that's why you need to pay 30% first. Okay? Even after I went crazy with it, not only I give them the whole savings, and I also give them an additional 5%. 14 is still smaller than 30. So I could pay a 14, a combined, I'll arrive at 14, versus I could make a payment to a 30. Well, I should be making the payment to the 30. So in this case, the line, as far as cash flow, because cash flow is equivalent to a payment, the line is no good, because I will not be sending a payment to the line. I'll be sending the payment to the loan. Okay? So we have good, good, no good. Okay? Okay? Over here, we have no good, good, good. So we have no, yes, yes. Over here, we have yes, yes, no. You see? Not good here, good here. Good here, good here. They're the same in the middle. Good here, not good here. And again, not good, good. Good, not good. The middle is the same as a dead weapon. Okay? So, reason why I kind of want to take my time on this lesson, America, because I know that some of the folks over at Velocity Banking who are teaching about that stuff, I know some of them meant well. Okay? They're not bad people. It's just they are misinformed. Okay? So that's why I want to take that time and kind of break it down for them. That way they start spurring out nonsense about a line is better than a loan. Okay? I know they don't understand interest rate, how interest rate works, and I know they don't understand how amortization the amortization schedule works. Okay? So that's why there's a lot of confusions for them. Okay? So every opportunity that I get, I'll try to break it down a little bit. So that is why a lot of times my lessons are quite long. Because if I was going to go through that little exercise, I would have been done. Okay? But because I know not everybody has the same level of knowledge, including, the financial coach or the financial coaches over at Velocity Banking Group. Okay? So we're trying to help them out a little bit. Okay? Because my method is for all coaches. Okay, whether you belong to Debt Snowball or you used to use that kind of plan, whether you belong to Debt Avalanche or you used to use that kind of plan, or whether you belong to Velocity Bank. Okay. We're trying to have all coach to move over to Ambroise Method, because we know for sure that we have a superior debt repayment method. Okay, I challenge these guys, any day of the week. The day America, that snowball group kicks my butt, I'll start teaching about Ambroise Method. I would love to see that day, man. I would love to see a day when I get my butt kicked by that snowball group. I would love to see a day when I get my butt kicked by that avalanche. I would love to see a day when I get my butt kicked by this confused bunch called velocity banking. A line is better than a loan. No. Depends on the context. All right, America. I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. Alright, so hopefully they'll keep this little cheat sheet done by the folks over at Velocity Banking Group. That might help them out a little bit. There goes the cheat sheet. For Chunk, you all did. Spirit of Father, thank you. Now, let's compare let's quickly compare our method with that snowball. Well, let's talk about some of the flaws that the folks over at that snowball group has. That snowball wants to attack the lowest balance account. In this example, we have 20,000, 24,000, 44,000, 10,000. Oh, looks like they will be attacking the HELOC. Let me erase some of that stuff so I could go a little higher. Okay. So, what these folks likes to do, they're gonna attack the lowest balance. Every other account gonna receive bare minimum payment, and the account that has the lowest balance, this is where cash flow goes. Okay? And cash flow in this example was 2,000. Okay? So cash flow will go to the lowest balance. Okay? So on our attack, they're taking advantage only. They're taking advantage of the cash flow. Okay? All right. And again, folks, remember when you're paying off debt, you might come across 3 different elements, 3 different assignments, 3 different jobs. Okay? Transfer, alternative account, cash flow. So they're only taking advantage of the C on our attack when you're paying off debt. Okay? So they're doing 1 of the 3 items. So 1 out of 3. Which is what? 33%. Last time when I was in school, America, 33% was a failing grade. Last time when I was in school. Let's move over to debt avalanche. Debt avalanche, just like that snowball, they want to take advantage of cash flow. So they're going to send minimum payment to every other account, and cash flow going to go to the highest APR account. In this case, we have the secured personal loan, 30%. Okay. And again, they're taking advantage of just this C, just like that snowball. And we have 3 items, so they're only taking advantage of 1 of the 3 items. Out of 3, and again that's 33%. Last time, America, when I was in school, 33% was a failing grade. So they're not doing all of the assignments. They're not taking care of all the elements. They're not taking care of all the jobs. We have 3, they're only doing 1. 33%. Well, how about velocity banking? For velocity banking, well, you know, these folks, they chunk. They have a debt weapon. And we have cash flow. And that account will keep cash flow for 3 months, 6 months, 9 months, 1 year. Okay. For chunking, they'll chunk out of the HELOC because the HELOC is their preferred debt tool or line or credit line or debt weapon or debt destroyer. For debt weapon, they'll use the HELOC. And again, they're going to dump all of the income or all your paycheck into the HELOC. And for cash flow, they also keep cash flow inside the HELOC for 3 months, 6 months, 9 months, 1 year. As you could see, America, they have HELOCs everywhere. These folks, they only know one way on how to use this alternative account, is to run everything through that alternative account. Okay? And remember earlier when we were giving them, making a little cheat sheet for them, we showed them that for these items, sometimes it's good, good, no good, or sometimes no good, good, good. Depends on whether the line has a higher APR, considerably higher APR, or whether the line has a considerably lower APR. Okay? So, for them, no matter what the situation is, they're going to run everything through the HELOC. And we've proven to you earlier from the cheat sheet that you cannot run everything through the HELOC because all of these are different jobs. Chunking is a job. The account that you use as your debt tool, that's another job. Cash flow, the account that gets to keep the cash flow, that's another job. Because your trade lines, your traditional trade lines are always in competition with themselves to see who gets to keep the cash flow. Okay? So that's the problem. Can I run everything through the HELOC? And we've proven that earlier when we were comparing line versus a loan. Even when you compare line versus another line, like this credit card that's on the board, okay, it will not be the HELOC. Okay? So, for chunking, they always chunk out of the preferred debt weapon. So, one chunk at a time. Generally. For debt weapon, they generally use one debt weapon at a time. Or for cash flow, well, you know, that account will keep, the account that they use as the debt weapon, gonna keep the cash flow for 3 months, 6 months, 9 months. Okay? So they'll be here. For us, transfer, let's put Ambroise Method here. We typically don't do just one transfer. Depends on the example. We have at least seven different ways on how we execute balance transfers. At least. So let's put greater than or equal to 7. Okay? Because we have at least 7 different ways. For debt weapon, we don't use one debt weapon. Depends on the example. We might use 1, 2, 3. That's why I have a lesson I haven't covered called 3 alternative accounts simultaneously. 3 alternative accounts simultaneously. That lesson I haven't covered yet because this one is kind of complex, America. So I could be using 3 different debt weapons at the same time. These strategies or techniques, America, were unheard of before we come onto the scene. Okay? Revolutionary type items. Okay? Nobody in America is doing that kind of stuff. Okay? These folks, they're struggling with one debt weapon, let alone 2 of them, let alone 3 of them. Again, 3 alternative accounts simultaneously, that's a lesson I'm going to cover down the road, folks. Okay, so bear with me. Okay, I don't know, maybe I'll change my mind. Maybe I'll reserve it only for financial coach. I'm not going to release it to the general public for regular Janes or regular Joes. Maybe, I don't know, I haven't decided yet. Okay, because I want the financial coach to have a little bit of edge. That way these folks, my financial coaches, when I decide to offer training for financial coach, that way they could bring value to you guys. Okay. Anyway, then for cash flow, we generally send the cash flow to the higher APR. So the cash flow might go maybe here, depends on the example, because sometimes they're no good, sometimes they are good on the cash flow now. Okay. So cash flow might go here to the HELOC or to a different account. In this example, the cash flow did not go to the HELOC. The cash flow went to the secured personal loan at 30%. Remember that 2,000 cash flow went to 30%. So 2,000 times 30%, that's how we arrive at the $50. So that cash flow will go to the IRPR one, not the HELOC, but the personal loan. In this particular example. Okay? And again, for debt snowball, you're only using cash flow only. Okay? They're not turning in all the assignments, only turning in 1 out of 3 assignments, 33%. You could call it a failing grade. Okay? These folks, they don't go far enough. The folks of our debt snowball group, they do not go far enough in eliminating debt quickly. Only taking advantage of cash flow. America, that's not going to get the job done. Similarly, for debt avalanche, they're only taking advantage of cash flow. Again, they're not turning in all the assignments. 1 out of 3. Remember, we have transferred. Several months ago, the folks of our Velocity Banking, they execute a transfer. Okay? Several months ago. Okay? Because the balance on the HELOC was 0. Okay? until they start doing, because remember it's a new acquired HELOC. Because these folks over at Velocity Banking, they like to tell their client to go out there and get a HELOC, get a PLOC to pay off debt. Now, okay? So they take advantage of transfer like Velocity Banking did several months ago. Okay? These folks, they don't use alternative account. Only cash flow. Again, sending cash flow to our APR account. Okay? That alone, okay, would not get you to the finish line faster. Okay? So the folks over at that avalanche, they do not go far enough in eliminating debt quickly. Okay? Not only did they turn in all the assignments, okay? So for not turning in all the assignments, you're going to be a lot slower compared to somebody that turned in all the assignments like Velocity Banking did. The reason why, sometimes the results of Velocity Banking is worse than the results of that snowball, that avalanche, because these folks, they don't fully understand a line versus a loan. When we have line on the board versus when we have loans on the board. Because what they want to do, they want to run everything through the HELOC. HELOC. We refer to that sometimes as favoritism or fanaticism, but favoritism says the favor this HELOC. No matter what example we have on the board, we have a credit card at a higher APR, they're gonna pick the HELOC. We have a credit card at a lower APR, they're gonna pick the HELOC. We have a loan at a lower APR, they're gonna pick the HELOC. We have a loan at a higher APR, they're gonna pick the HELOC. So these guys never run the numbers at all. They're just blindly doing things. Let's run everything on our preferred account, which is the HELOC. No matter what the example is on the board. They don't care. Let's use the HELOC. Let's dump all our paychecks into the HELOC for 3 months, 6 months, 9 months, 1 year. And with regards to the cash flow, this is where we're gonna hijack it. We're gonna keep it. Okay, folks? Now, compared to us, watch. They're using the one chunk. They generally, perform one chunk. Look at us. We have 7 different ways on how we execute balance transfer. So 1 versus 7. Which debt repayment method you think America are gonna go past the finish line first? As far as debt weapon, one debt weapon, they generally use one debt weapon at a time. For us, in one example, when I introduced to you guys these 3 alternative accounts simultaneously, in one example, we could be using 1. From my past lesson, past case studies, I've been using 2 for sure. So you guys already got used to 1 and 2. 3, I haven't done that one yet. But as far as 1 and 2, you guys already know how to use 1 at the same time. 1 alternative account or 2 alternative accounts simultaneously. Okay? So I still need to cover the third one, where I use 3 alternative accounts at the same time. So 1 versus either 2, 1 versus 3 after I introduce that lesson. Okay? And again, which debt repayment method you think America are going to go past the finish line first? And finally, for cash flow, we don't keep cash flow inside the HELOC for 3 months, 6 months, 9 months, 1 year. The HELOC was at a much lower APR compared to other accounts that we have on the board. We understand over at Ambroise Method that these trade lines are always in competition with themselves. That's why we don't keep no cash flow in a 9% account. Even after movement, that 30% was too high. That's why we send cash flow to the personal loan. Okay. That was the one at 30%. All right, folks? That's the difference. The reason I'm able to break this thing down so easily is because over at Ambroise Method America, we've already mastered this thing called paying off debt. Our method America is second to none. In essence, we are the #1 debt repayment method in the entire United States of America. This Ambroise Method is an American treasure. We're doing revolutionary things, man. Stuff that were unheard of. 7 different ways on how at least 7 different ways on how we execute balance transfers. 1 alternative account, 2 alternative account, 3 alternative accounts simultaneously. That is just to name a few. Ambroise's wash techniques earlier. Ambroise's partitioning of balance. Ambroise's charge pay technique, normal. Ambroise's charge pay technique, inducement. Shock and awe. The list goes on and on and on. Okay. Hopefully we could get this thing in schools.